Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 76. And this week on the podcast, we have a very distinguished guest join us for a conversation about mergers and acquisitions. Mike Vann, who is president of the Vann Group out in Massachusetts, joins us to talk about his experience working in the space and shares wisdom about what business owners need to think about when planning their succession, their exit, building value in their business, even if they don't anticipate an exit for some time, because that's the exact space that he works in, and he knows a whole heck of a lot about it. So we had a really good conversation about those items. We talked about the potential impact of President Biden's proposal to change the way that we're taxed on long-term capital gains and the potential removal of the step-up in basis, which I touched on in last week's episode. This was a really good conversation. And if you own a small business yourself, you're thinking about buying one, thinking about selling one, I would suggest that you listen to this episode, particularly in its entirety, because Mike drops a lot of nuggets of wisdom. I hope you enjoy it. Mike Vann, thanks for coming on the podcast today.
Thanks for having me. Good to be here.
So I am really excited to have you on the show today because you have a lot of experience in mergers and acquisitions, succession planning, exit planning, transitions for both buyers and sellers of businesses, if I'm understanding your background correctly.
That is correct.
I'm looking forward to just picking your brain and learning about what you do and what your process looks like and what you've seen, especially over the last 15 months in the M&A industry.
Yeah, it's definitely been interesting times.
Yeah, it's definitely been interesting for everyone, for sure. So why don't we start with this, Mike? Why don't you tell us a little bit about yourself and your background and how you got started in M&A?
Sure. So my background, the Vann Group is a family-owned firm, and so you've got to kind of trace it back to that point. And I swore I would never go to work in the family business, and went to school in the Washington D.C. area. So left my native Massachusetts, and graduated and went to work, for a Fortune 500 company, and just really, really hated corporate. So my father said, "Hey, why don't you come back home? We've got, someone to we need you to run the consulting side of our business, and you can figure out the M&A side." He just bought this little company called Split Rock Capital from another intermediary that was the only one in our area. And so the timing was perfect for me to come home and jump into it. And so that's what I did, not knowing really anything about mergers and acquisitions, figured it out on the fly.
And so that was tried and tried, but you just still got roped into it, huh?
Exactly. Yeah. Just when you think you're out, they pull you right back in.
Yeah, that's right. Now, did your father start the firm?
He did. He started in 1979, and very entrepreneurial. So, he had an accounting practice, which he's still in today, but it also owned a variety of other businesses in real estate development and transportation and aerospace and driving ranges and ice cream shops. So anything that he could find to buy and make a buck on, he was always into. And that's been the history of the family. And so we do a really lousy job working for other people, I guess. And, coming back into the family business was a natural progression for me because I did a lousy job working for someone in corporate. So that's how we got here, and been here with my mother as well and one of my sisters. So it's a true family business.
Well, being a crummy employee can have its perks from time to time.
It helps you figure out where you belong real quickly.
Yeah. So your dad, CPA practice by trade, sounds like, and then he got into non-CPA, but like accounting.
Accounting, enrolled agents, and really good on the tax side of it. They specialize in the tax side of it, so they don't do reviews and audits, and because of that, a lot of business advice and guidance. So it was a natural addition for me to come in from that side, because that's what I did in corporate, was consulting. And when I came in, there was a huge need in the existing client base for just general business advice and guidance.
Yeah. I'm always interested in hearing the genesis of firms like yours, because people will often come from investment banking, maybe the Wall Street background, and a lot of a lot of expertise comes from the accounting world as well.
Definitely.
So that's a story I hear pretty frequently. And so your dad's running this accounting practice, doing a lot of tax work, and then does he start buying firms or businesses himself, rehabbing and turning around selling, or is he buying as an agent on behalf of other people?
It was really both. He'd started his first practice when he was 18 as a bookkeeping company. And it really was always initially in those early years just as a way to create cash flow while he was busy looking for deals or doing those types of things. And then as that practice grows, and if you're in your early 20s, your client base is kind of in your early 20s. And those business owners are looking at how do they grow, and acquisitions were a natural extension of that. Everyone was looking to do a deal. So, and everyone needs an accountant in that deal. So that's how he got, into the M&A side of it, both from an internal need as well as for a practical need for his clients.
Gotcha. So you grew up around this stuff. You go off to college, work in corporate for a little while. What was your role in the working world?
Well, I started off as a controller and not knowing anything about numbers, but my mentor who hired me said, I need a controller. You can figure it out. And did that for a little while, and then grew into, the consulting side where I fell in love with that. And it used to be kind of this boring stuff of doing cost benefit studies on, outsourcing military functions at bases and those types of things. But fell in love with kind of the strategic facilitation side of it, because we would go in and do that for groups, and thought that was just a ton of fun, to go in and help someone build their strategy and figure out where to take their organizations. So when I came back here, that was kind of the initial focus, was working with companies on strategic planning, and developing their organizations to scale. And again, M&A was a natural part of that, because those companies are always looking for inorganic growth avenues to accelerate that path.
Right. So it gives you a front row look at a lot of the deals, and getting a lot of reps is probably very helpful.
Yeah, and then I started, basically on the buy side versus the sell side. So I got to see the process and ride it from a buyer's perspective, which is one of the things when we're selling a company, we always try to, instill in our customers is you got to think about your business from, the buyer's perspective. There's all these things that about the business that are natural that they don't know. And even the most simplest thing they're going to dig into, and they're going to be a pain in the ass about this and wanting to know why and understand it. And you better have those answers, and they better be good answers. And so bringing a buyer's perspective to the sell side is always, I think, very advantageous.
Yeah, that would certainly be a helpful experience. What did you not like about that world? What drove you out of it?
The corporate side? I think it was just the structure to it. It was crazy. That's, there was, I worked for a pretty entrepreneurial corporate company like that, which was great. So I got to see that side. But, at the end of the day, you had a boss, and I hated having bosses, and they were great bosses, but I still didn't control what I was doing on a day-to-day basis. And so you're answering to that, and you would do a lot of work, particularly at that size, things that really didn't matter. It was, what? Congress earmarked, they want this study done. And so the military really doesn't care if you want to outsource a base function. They don't want to do it, but someone's got to do the study because there's been money earmarked and says we need to do it. And so I think, not seeing the benefits of the work you would put in, was frustrating. Whereas, if you're working with a small business, you can come up with your recommendations and help with the implementation and see it through and see what the result is. And to me, that was always the fun part, was to can we take a company from X and bring it to Y in size, or can we, help actually get this thing sold, and you get to see the fruits of your labor, so to speak.
Yeah, absolutely. You describe it in a very positive way. I might add. The word you used was the structure. The word that I would use is bureaucracy.
Yeah.
Which is a more frustrating thing that we've probably both experienced.
Well, essentially, the company I was at wasn't necessarily bureaucratic, although there was definitely those pains when you're that big, but it was highly entrepreneurial. And so you would deal with almost these other issues where if you were going after a contract or something, and these are all RFP government stuff, there might be 6 other bidders, and 5 of them are people from your company. different divisions. So it was very, very scattered, very competitive. So it was a good training for perspective of coming out on your own and being an entrepreneur. Of you really had to fight for things, but it's also frustrating as hell. It was like, can't this company get its act together and go
Right.
after this as one company? But not meant to be.
Yeah. Yeah. That's an uphill battle for any executive trying to put one unified vision together. So you go back to work at the family business. How did that build out go? Because the way you phrased it earlier was that your dad needed someone to head up the M&A, mergers and acquisitions efforts at that existing firm. Were you starting from scratch? Was there an existing base
No,
of anything?
pretty much starting from scratch. Both on the consulting side and the M&A side, and it was all right. You're 26 years old and baby faced at the time, not so much now. And here's a business card, and you better go start meeting people. So literally had to build it from scratch. It was certainly helpful that there were clients here to network with and get introduced to, and some projects here and there. But I think, first year I probably did $36,000 in revenue, it was coming from a nice job that made a lot more money than that. It was humbling, but continued to do it that way. And I got to a certain degree lucky that I landed with a company that was acquiring another company out of bankruptcy court, and they needed someone to run with it. And I did that, and they were a young company that didn't know anything either, so they just kept using me more and more. And so I built a really niche practice for a number of years, working for maybe 4 or 5 companies on retainer basis, just doing whatever they needed to do. These were all very, growth oriented companies, and, just needed someone to execute on things for them. So it was a great experience. And then, suddenly they started to sell, which is no fun. So, because when you've got only a couple clients and they start to sell. So I
Right.
learned another valuable lesson about diversification. And so that was in about 2012, 2013. So we then pivoted the practice to focus a lot more on sell side, M&A, and, scaling the consulting aspects of our business with the succession and transition planning, the growth planning to lots of customers, rather than, building that, very niche practice.
Right. Right. That's it's a heck of a journey. I mean, you start anything from scratch. I went through that in my financial planning firm too. I mean, the first couple of years are really, really lean. Humbling is another positive way to put it, my
Oh
friend.
yeah. Well, the turnover. I mean, the turnover in your industry from starting is just brutal. How many? I mean, I can think of all the classmates I had who went into financial services, and some of them last 6 months, 2 years, and then they just move on to something else. So
Yeah,
very, very
it's an
right.
interesting industry because these days the costs to starting like an independent advisory firm like we have are really very low. I mean, you can get it done for less than $25,000, pretty easy, and you have some technology systems and ongoing overhead that you have to subscribe to, of course. But the bigger hurdle to people is bringing in enough of a client base and revenue to be able to pay your own living expenses before you run out of money. That's the biggest barrier to entry. It's not like starting like a restaurant where you have huge capital expenditures on day one. It's just, can you last over the first 3 or 4 years and
Yeah, we call
achieve
it
that peak?
basically the chase for can you find a viable market before the cash flow runs out.
Exactly. Exactly.
It's one of those markets you can't stay a startup forever, because
Hmm.
the staying power isn't there.
That's right. That's right. So what was it? What was it like working with your dad?
It's been great. We're very complementary as to skill sets. He gets to be the gray hair guy. He's still here. He's 67 and he works more hours than anybody still. And I was the younger guy, so with the more of an analytical mind, and he was more of a street smart type of guy. So you combine the two, and you can have a pretty powerful offering. And so we were always very complimentary of each other with our skill sets. And he never, I would say, big timed me like, well, I'm the boss, or was always been very deferential in those standpoints, and to me likewise with him, as to where I have no problem saying, you know what, this needs you, because the client needs to hear from somebody who's not me, with that grayer hair, with them, the longer experience. And so it's been great.
Does your dad still own the enterprise?
He does. He's gradually transitioning out. My sister is now a partner in the accounting practice. I'm not. I've stayed out of the accounting side of it because I grew up watching it and knew I didn't want to be in that business. Like a lot of our clients, with their kids, and that, why don't they go in the family business? Well, because they saw it. So I'm kind of the same way with the accounting side of it. And, but he still owns it, and it's positioned, it's got its own transition going on now. So it's exciting.
That's great. So as someone who specializes in helping businesses transition, particularly those between family members, what's it been like for you, both transition into an ownership role yourself and witnessing it with your sister? I mean, everybody has a little bit of, the cook not eating his own cooking to some degree. And I just see that in pretty much every business owner that I talk to. What's it been like for you?
I mean, so I was lucky, we had set up our own entities, my own entity, when I started this. So I never had to worry about the ownership side. But to that point, when we were starting to think about the planning side of this and what this was going to look like, we brought in another expert. We were smart enough to know that you can't do your own succession and transition planning. So we went to a great guy, Ira Brick, who ran the Family Business Center at University of Massachusetts. And we sat with him and, did he wasn't on the number side. We didn't need him on that. We needed him to talk through the emotional side of it, and who gets what, and how does this play out, and how do we manage this, the softer side of it, because we can do the numbers and figure out that piece. That's easy in our regards, but the softer side is always a tricky piece when it's your own stuff. I can give great marriage advice, but applying it to myself, not sometimes the easiest thing to do. And it's the same way with any type of business advice.
Yeah, that's a really good point, and wise of you all to take that step. Well, just for the benefit of our listeners, most of our clients at the financial planning firm are business owners in some way, shape, or form, but that's not everyone. And we do have a pretty rapidly growing audience. It's not huge, but I suspect that there are a lot of people listening that have no idea what we're talking about. So could we take maybe a quick step back and just talk about a framework of what a typical business ownership transition looks like, both on the analytical side, the emotional side, and maybe just give a little bit of context and background.
Sure.
All
So
this stuff.
A lot of it depends on where you are in your life cycle as a business owner. So a lot of our younger growth-oriented companies, and we're dealing now with owners who are in their 30s and 40s, and maybe even early 50s, they're looking at it from the transition is 10, 15, 20 years out. So they're looking at planning from a very different perspective, right? It's more about how do we grow and get to a value point that we're looking at in the future. A lot of our succession and transition planning work, though, comes into these ones who are, in the 3 to 5 year window, ideally, but realistically, it's a lot of time 1 to 3 years from a transition. So now it's a question of, well, what are my options? Do I go and sell to the market? Is there someone internally? Do I have family members? Are there partners that I need to deal with in the buyout? So there's suddenly all these different things there that come in from the business side, but there's also this whole other aspect of it from, the family side of it, not just if you've got family in the business, but, if you're going to retire or sell the business, what does that do to your family life? What are you going to do with yourself post-transaction? There's the financial side that we think about that you guys come involved in with, is like, all right, if we sell the business for X, is that enough to meet your retirement requirements and what you want to accomplish in life? So a lot of, as the statistics are horrifying as to how many business owners have actually done any transition planning, estate planning, retirement planning. And so, we're bringing these questions up to them from the first time, and it's usually because they're starting to see the end coming on the business side of it and are confused as to what they should be doing. So one of the first things we do is have you sat down with your financial advisor to figure out what it needs? Because I can tell you what the business is worth, an approximation, and give you an idea of what it might get on a sale. But if that number doesn't align to what you need, there's a lot of different things that we're going to need to do to get to that number. And it may require significant investment. It may require extending your timeline and horizon. So let's have that conversation early on here, so your financial advisor can explain to you how a business sale impacts you.
Yeah, and I might add, I mean, these are not trivial numbers we're talking about. You don't have to have a huge business and multiple seven figures of revenue to make a difference in the amount that you walk away with after taxes through putting a concerted effort in over 3 to 5 years, right?
Absolutely.
I'm sure you could rattle off half a dozen instances where you boost value very substantially, and that's a huge that has a huge impact on the business owner and their family.
Oh, definitely.
For the next couple generations.
Yeah, because if you can drive that cash flow number and you can drive that multiple, they're life changing.
Yeah.
As to how that's gonna come together. So it's really important to understand what those numbers are, because we can create a plan and a structure for you to get there if you have the motivation. And that's part of the problem sometimes is that we have owners who are, if they're talking to us, it's in that stage, it's because they really don't want to put any more energy or investment into it. They're getting risk adverse. They want to start to take their chips off the table. And now it becomes a much harder conversation as to, well, we can't get to that number that you're looking for from a sale. So now what's plan B for you? If you decide you don't want the business anymore and you want to cash out, what are you going to do? So it's a stressful process for a lot of business owners, which is why I think they, avoid it. No business owner I've ever spoke to wants to think about the end. It's the same as why people don't like to plan for retirement or estate planning, because God, I'm going to live forever. But we know a simple fact, right? 100% of business owners are going to exit their business at some point.
That's right.
Doesn't matter who you are, what you think you're going to exit at some point, whether you wanted to or not.
That's right. That's right. And I think any prudent business owner would probably agree that it's really important not to have a bunch of yes men and yes women in your inner circle. You need somebody objective to come in and give you the cold hard facts of where you're at, and then to help you determine whether that's in line with what you're seeking or not. And so many people across the country put off retirement planning, they put off estate planning. It's uncomfortable, they don't really want to do it. I think it's more so for your typical business owner across the country, because your identity is wrapped up in that business. And it's scary as hell thinking about the possibility that you're going to have to, rebuild your life after that goes away.
Yeah, no, that's a huge part of it. There's an ego and a fear factor as well. What do I do? Who am I if I don't have this business? I always joke that, you spend 60, 70, 80 hours a week in your business sometimes when you're an owner. And that's a lot more time than you spend at home with your wife and your kids and everything else. It is your identity, and it's what you do. So that suddenly to take that away can be very disruptive for somebody.
Yeah,
and that's why they kind of avoid the conversation, because they know that.
Mm-hmm. Absolutely. So back to what we were beginning to get into here a few minutes ago. You have a transition maybe with somebody that you know or a family member. How do those relationship dynamics impact what we're just talking about? Knowing your number, doing a little bit of planning, knowing objectively what you're trying to get out of such a transaction on your way out. Now let's say, well, what if the person you're trying to sell to is a friend or a family member? What do you have to do?
Oh, it's a lot more complex because of those relationships. And it's not only the relationship, it's also what they know. Right? They know you probably better than anybody else, as far as like from a transactional standpoint, right? So they also kind of know where the bodies are buried, so to speak, in the business. They might, a buyer might have a kind of sense of entitlement as to, well, I deserve this, because I've been loyal and I've worked to your heart, all those types of things. So there's just a wide range of dynamics that come into an internal transaction, not the least being that our buyers typically don't have any money. And it's the whole objective is to sell your businesses to get your money out. And yet now we're talking to a buyer who would be great to run the business because we trust them and we love them and they're dear to us, but they can't convert this asset that is our biggest and most valuable asset on our balance sheet in most cases into liquidity. So now how do we deal with those things? And that's a hell of a dance, because it's comes down to the risk factor. And, a lot of our sellers want to take the risk off the table. And sometimes our buyers don't appreciate the level of risk because they're going to pay more for it because they don't have the money or the capital, and they're going to get a favorable deal. So there's a lot of nuances to walk through, a lot of complexities.
Yeah, that's a really good point. You not only do you add to the fact that you have all these relationship dynamics that have to be maybe not resolved, but tread on lightly and at least accounted for and managed. But then add that to the fact that if you're trying to exit the business and sell and get as much as you can for it, the one party that's going to cause you all the additional struggle and headache doesn't have the cash to pay for it. So you have to finance that through a seller-owned note or get a bank involved, and that's just that's a major hurdle.
Definitely. And so a lot of the structures we do is we try to, if we have a long enough window of a time, is to start to bring that key person in as a minority owner, and get them some level of equity stake. So when they do need to go to the bank, they've already got something built there. Mm-hmm. They've demonstrated that they're a shareholder. So they've demonstrated a track record of performance. We've got them to an equity level that, makes it easier to finance. So we try to do those types of things in it. But then that also creates some complexities too, because we had different tax issues that arise now if you're buying out the stock because you're a shareholder. So now we don't get the write up and the assets, and now we have to balance the tax issues, and we still need to get financed, and we still don't have any collateral, even though we've got some equity, but we still have to run into some of those things. So there's a lot that goes into, our internal transitions.
Yeah. And I want to dive back into the tax issue a little bit more here in a few minutes,
Sure.
Especially with the possibility that long-term capital gains go away and step up in basis goes away. But first, I'd like to hear about what the last 12, 15 months have been in your world, both in just, day-to-day working with people, helping them through these transitions, but also what do you see in the industry at large and deal flow with the pandemic?
Yeah. So when the pandemic hit, when we were dealing with the first 15 days, right? 15 days to slow the spread and then everything to go back to normal, our world shut down. And it didn't start to, even have a phone ring until maybe mid-May. And, any deal that you were working on at the time when the pandemic hit is stopped. There were no closings. There was no, continued negotiation. Let's see what happens over the next month or so. And, so you suddenly saw just complete inactivity. But then around mid-May, the phone started ringing again. You started to see buyers who still have capital, our private equity groups and our search funders and some of the strategics. They still need to buy a business. They still want to buy a business. So they started to pop up, and we saw this kind of other trend with some of our, if they weren't a seller before, at least kind of conversations about, what, I'm done. I'm not going through another rebuild and all this. Just get me out. I think I've realized that, life's too short. I don't want to do this anymore. So let's start to figure out this transition to get out of the business. So we've seen that. So we've definitely seen some increased activity. Valuations, I think, have stayed reasonably consistent. They've recovered somewhat. I don't think they're still on this crazy trajectory to the top. I think one of the challenges we've seen, though, is, maybe the senior debt that's going to come into a deal isn't as high as it used to be. So we're looking for, some more seller participation in our deals. And that's, again, not something a seller wants to hear, particularly when they just want out at this point and they've seen it.
Right.
But I think that's kind of the reality of it. So there's been a lot of activity. And if you were what we call pandemic resistant, if you weathered this pretty well, you've probably done better than what you were doing before the recession or
Yeah.
the pandemic. I mean, we had clients who, everyone took the PPP. It was without a thought. And then you looked at a lot of them and go, we really didn't need that. And so when the second round came around, and even if you qualified, you kind of went, there's no reason for us to take this.
Mm-hmm.
But it helped, I think, a lot of businesses get through kind of that uncertainty, because the first advice would have been when that started to hit was to cut everybody. And with the PPP in place, you could at least say, well, let's sit tight and give it a few weeks to see what happens here. Now we've got this money. So I think it was valuable from that standpoint. And it allowed some of these companies to, recover faster and start to see those trends. So when we did do deals, we could look and say, oh, yeah, March and April were horrible, but look, May increased and June increased and July increased. And, end of the year, we're back onto our regular run rate.
Mm-hmm.
So that was helpful.
That is really interesting to hear you say, because round one of the PPP, the criteria for obtaining a loan, the bar was pretty low. Basically, you can just check the box that says that you need this due to economic uncertainty, and you can qualify for a loan.
Yeah.
But round two, you have to show a 25%. Is it month over month or quarter over quarter?
It was a quarter, yeah.
Quarter over quarter
that had a decline,
right, by 25%.
by 25%.
And you can choose any of the 4 quarters of 2020 over 2019 to qualify. But what you're saying is that even the businesses that qualify, meaning that they saw their revenue drop by 25% quarter over quarter, didn't feel like they needed it, which is astounding to me. That's crazy.
Recovered that quick. A lot of them recovered that quickly. I mean, I can point to my own situation. I looked, and yeah, I had a 25% drop, last whatever quarter, March, April, so second quarter. But when I went to look at it this year and saw the PP, I'm like, my numbers are up over, over the previous year. Never mind, so yeah, we had a bad quarter, but everything recovered and accelerated. So how can I, in good conscience, take the free money? So, and I had a lot of clients who did that. They looked at it and said, hey, we're sitting in a better cash position. We've got a great backlog, or, everything's going well. So we just can't in good conscience take it. And then there's a concern too. Well, what happens if you do take it, and did you really need it if someone looks at it? So I saw a lot of our clients just, opt out of it in the second round.
Sure. Yeah, it's really interesting how this thing has evolved. But I'm glad to hear, things are recovered from your standpoint. And one of the things that I look at too, and we don't see a whole lot of deals in our financial planning practice because our clients are long term. We have fewer clients for a long period of time. Is we kind of compare valuation levels in the public markets to what's going on industry wide in deal flows through EBITDA multiples and stuff like that. And public markets valuations are really, really high. I mean, the easiest, most prominent one, the price to earnings ratio, it's in like the 95th percentile over the last 150 years, which means that it's pretty expensive, and we're expecting a substantial economic recovery, which seems like we're on the trajectory for already. So interesting for sure. Let's talk about taxes for a minute or two. What are your thoughts? I surprised you with that one, huh? So what are your thoughts on how your sellers would be impacted if long-term cap gains rate goes up by 20% or so?
It would be devastating. If you think about, that perspective, if you go from, in Massachusetts, we got a 5% capital gains on top of the Fed at 20. And if you suddenly go up to 43% or whatever number they're talking, at least in our states, I mean, it just absolutely deflates you. You're leaving that much money on the table and giving up in taxes. It changes the dynamic of selling. So we're already starting to look at it as to what it's going to do, and we think it would really shut down the M&A market. Drop it, because it's now your sellers need to pick up 20% somewhere else. All this years of retirement planning and wealth building and positioning go completely out the window with that. And then never mind what that does to the thought process on multiples and valuation if there's a longer, if the tax situation and the return isn't the same. So we think you'll see, owners, look to other avenues rather than a sale. Maybe there's an ESOP option, as a potential there, or maybe you're going to, do a internal sale that's much slower, so you can lock your internal team in and then, get a flip when there's a change in administrations. So we're definitely very concerned about it in our space as to the potential impact.
Yeah. And that would have a larger impact than the elimination of step up and basis, I suspect, because owners want to capitalize on what they've built through an exit where they're getting cash out and having to realize those long-term gains, as opposed to bequeathing the business to their kids, which means that they don't realize anything.
But in
right?
those situations too, there's a real big concern is a lot of these family-owned businesses where a sale isn't expected, where there is going to be, a transition as part of an estate planning process, to suddenly, have this type of tax hit.
Yeah.
It's massive. It'd be devastating, and I think it's kind of, not to get into the political side of it, but disingenuous that, suddenly this stuff comes up when you're in the midst of potentially the largest wealth transfer in the history of the nation. And, who's it going to hurt the most is your small and mid-sized business owners.
Yeah. Yeah. And what I've read about it so far is that they are thinking about $1 million exemption from, or let me put it more clearly, if your income is less than $1 million, you can still take advantage of the long-term capital gains tax preferences. But that's not going to apply to most of these exits, right? I mean, what is the range of deals that your group typically works on?
So we typically work on deals with EBITDAs from $500,000 to, 5-6 million is a typical deal. Let's say the average is $1.5 million, $2 million EBITDA company. Those are $6 to $10 million EBITDAs, are exits. So that in those, if you take one of those companies, a typical manufacturer, maybe employs 50 to 75 people, capital intensive. That's the type of the company you're talking about. And those companies are making that, as S corps, with the pass through, they're making that every year. So now you're going to just throw that tax factor into it on the pass through basis. Just very, very challenging for someone. Then they want you to invest, and you get the increased labor costs and supply material costs. So it's just, you're getting it all on all sides right now. The last thing they should be doing is looking at, increasing capital gains cuts while they're increasing costs on everything else.
Right. And I don't suspect that in that range an installment sale would be that beneficial, because you have to stretch it out over too long a period to get under that threshold, right?
Yeah, and if you're in so you take Massachusetts, a perfect example. The installment sale gets taxed at full value at the time of the closing. So it's not, then you get to take the credit against it each year. But, like I said, we were looking at one today where there's an installment, the buyer had proposed, and it's a pretty sizable, it's, several $1 million. And I looked at him and said, well, great, that's going to cost my guy $250,000 at closing on the tax hit on that. So we've got to think about that differently. Never mind then if you were to increase that number.
Right.
So it's not a way to hide it either.
Yeah.
So I think, ESOPs may start to become an intriguing avenue for companies who have the ability to pull them off.
Because it enables the owner to exit over a longer period of time, bring employees into the fold, and a gradual transition, right, is tax beneficial.
It's tax deferred. So, and you can start that. You can do a minority interest with an ESOP to start to take money off the table and position it that way. It has some negatives as far as being able to maximize your value, but if the ability to maximize your value is limited because of the tax situation, I think it changes the dynamic for a lot of business owners They may have not been contemplating an ESOP because they're expensive.
Sure. Yeah. Yeah, absolutely. Yeah, it does get a little political. I'm someone who is concerned about the level of national debt and the dollar status as the reserve currency of the world, and a bunch of topics that I won't bore you with today. But it's concerning.
Yeah.
The trajectory, the spending and revenue of the federal government has to kind of offset each other, and they're both just going up really, really, really fast, and that's a concern.
That it is.
So, what is your vision for your company? Where are you wanting to take it next?
For us, it's a couple different avenues that we're focusing on. We're definitely keeping active with the M&A side and the transition planning component because those ebb and flow as the markets come. So another area where we're spending a lot of time is in the growth side of it. We been working with a lot of privately held businesses on how do you position your business to build value and scale. And that's a very active part of our business. I'm a certified scale architect, which is
Nice.
which is a great sounding title, isn't it? But that's through an organization called Predictable Success, which is a gentleman, Les McEwen, who had a best-selling book called The Predictable Success, and then The Synergist, which is really helping companies identify how do you develop your leadership teams, create an alignment in your organization, and position yourself to scale.
Mm-hmm.
And so that we see as a very active part of our business. And I think that's going to continue to grow, particularly if the tax situation changes, because now a lot of owners are going to need to figure out, well, how do I get this company to run without me? Because we may not be able to exit in the foreseeable future, but I don't want to be here.
Mm-hmm.
So how do I minimize the risk of that and create some financial and just regular freedom for myself?
Yeah. It's an evolving space, as I understand
Definitely.
it too. A lot of M&A people that I've spoken with are really interested in that too, because again, the impact that you can have on a privately held business is just massive. Just line up everything toward the objectives of the owner, and help them create a 3, 5, 10-year vision, and it's
Absolutely
can really make a huge difference. Well, very cool. What did we miss, Mike?
Well, we did a pretty good job. I didn't pitch my book.
Pitch your book.
Pitch my book. So we have a book on called "Buying Out the Boss: The Successor's Guide to Succession Planning," which we think is the only book out there is written from the perspective of the internal buyer. And how to think about buying the company, and we'll tell people that it's valuable for both the buyer and the seller to start to think through the process because internal transactions are very unique. They've got a lot of different moving parts and things that you need to be considerate of. And most of the books out there, everyone else targets the seller, so that's the guy with the money. Mm-hmm. So there's not a lot of advice for the buyer out there. So when we were thinking about writing a book, we thought we should position it from this perspective and give the perspective of how do you go about actually buying the company you work for.
Very cool. And you say we, who did you write it with?
Oh, my dad.
Oh, of course.
Father-son team,
Very interesting. Does the book touch on the family dynamic stuff that you two had to navigate, or is it more just perspective of buyer?
Yeah, it's just perspective of buyer. A lot of case studies, and we'll call them war stories, from things that we've dealt with. So I think pretty much every chapter begins with kind of that little anecdotal about, one of those companies that we've dealt with and some of the stories that we've seen and been a part of. So you can imagine there's been some crazy ones over the years. So,
oh yeah,
just when I think I've seen it all, something else, pops up.
Right.
So,
well, very cool. Everybody go check out Mike's book. I have no doubts that it's a wonderful read, even if you're not considering buying out the business that you work in right now. What else, Mike? The Vann Group is the name of the firm, right?
It is. Yeah, you can find us
website?
On the web. Vann with 2 N's -group.com.
Vann-group.com. Very good. Well, thanks again for joining me. This was great. It was enlightening, and I'm really happy you were able to come on.
Likewise. Thanks for having me. I enjoyed it. Good conversation.
My pleasure.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.